Good afternoon, folks. It's Dave Burrows, Chief Investment Strategist at Barometer Capital Management. I'm coming to you today recorded on the afternoon of May 26th, following a bit of a computer problem earlier today that had us abort the weekly live call. What I'd like to do this afternoon is just quickly review market conditions, some of the key leadership themes, and the positioning that we have here at Barometer. We're trying hard to stay in the important themes and stay focused in groups that are seeing multiple revision and nice earnings growth. Just to quickly kick off, we always start from the top, reviewing sort of the big macro view. And to start with, of course, we believe we entered a structural bull market in 2013 when we took out the highs from 2000. Of course, structural bull markets go on a long time. The last one lasted 19 years, 1981 through 2000. And through that period, not only was there earnings growth, but most importantly, you got multiple expansion at the same time, which allowed stocks, I think, to move much higher than people expected at the time. A similar period was 1951 through 66. Again, earnings growth, but earnings growth plus multiple expansion meant the market had long legs and moved sort of 4 steps forward for each 1 step back. And that's kind of the environment that we've been in since 2013. Certainly some significant pullbacks along the way, but we are getting a combination of earnings growth and multiple expansion, which is quite typical in a structural bull market. On the rate side, we think we've been going through a structural bottoming in long-term interest rates. The disinflationary theme that's been in place since 1981, we believe, has gone through a bottoming process, and bond yields are likely to be rising forward from here slowly and intermittently. But that means that the things that work going forward are probably different than the things that have led the market through a disinflationary period. And of course, that is the majority of all of our investing careers, 1981 to the present. Commodity prices have also been going through a bottoming process and look to have exited a structural bear market. And again, that's important, especially for the Canadian marketplace and the sector weights that we might want to focus in. So just from the top, the S&P 500 has been in this channel since the correction last fall, September, October. And since then, in a fairly orderly way, the market has been working its way higher as people slowly have been rebuilding their weights in equities. And interestingly, private investors have led the way, institutional investors sort of kicking and screaming along the way. But the old saying is, don't fight the Fed. There certainly has been lots of easy money. There has been lots of monetary easing, lots of fiscal policy, and certainly lots of winners coming out of the pandemic. So S&P continues to march along. Now, in fact, we're about the same place we were 5 trading weeks ago. So market has been consolidating, but that's really important because markets have to consolidate. And of course, they can consolidate one of 2 ways. They can fall in price, or they can go sideways in time. Both allows the market to digest the previous moves and get ready for another move higher. This is the equal weight S&P. Important to see that actually the picture is very, very similar. It has had, again, about a 5-week consolidation. Something we always watch for is under the surface. Is it just the leaders that are continuing on, or is it the broad-based market that continues to have strength? And that's one of the reasons we look at breadth. And the equal weight index tells us we actually have quite a stable market. And in fact, again, not much by way of volatility, market sort of marking time. Now, the one part of the market that has had a more significant consolidation, of course, is the NASDAQ. Now, it had a very significant rally off the lows last March. And has led the market for many years. But I think that this is actually representative of some of the rotation that's been going on from companies that have secular growth characteristics. In other words, can grow through sort of all kinds of environments. And those companies really have been few and far between over the last few years. Lots of investors piled into a lot of the same companies. And those companies have had a hard time making progress since the world started to believe we would come out of the pandemic. We would get an economic cycle, a re-acceleration in business activity, and that economically sensitive companies may in fact have more leverage in their earnings than the secular growth stocks. but are at a much lower price. So that consolidation has continued. We've tried a couple of times to get out of this range, and certainly the market has rallied a little over the last week. We're going to talk a little bit about that. The key message, I would say, over the last few months, though, has been rotation. So when we look at the Dow Industrials and how they've been performing, and this is, of course, what we hear about the S&P and the Dow a lot of the way that most people are positioned, which is a positioning that came about after many years of outperformance in the NASDAQ, are not feeling like they're getting their share, because frankly, the percent of stocks in the NASDAQ that are trading above their 50-day moving average has been in decline since February. So this is a stealth correction under the surface. Only 40% of companies in the NASDAQ are above their 50-day moving average. That tells you that the deterioration that we've seen, if any, in markets has been in secular growth stocks and in the NASDAQ in particular. On the commodities front, we continue to believe we made an important low back in early 2020. We broke the downtrend in, this is a broad-based commodities index, the RJI, the Rogers Commodity Index, that's been in decline since late 2008. Important beginning to a new bull market. And we also believe we have seen the early stages of what is likely to be a long period of sell-off or underperformance in the bond market. This is the 20 to 30-year bond ETF. Fell sharply into March and then really has been consolidating since then. We'll see whether they can get turned at all, but the likelihood is that it continues to weaken. Now, why is that? Well, I think certainly one reason is that foreign buyers have sort of disappeared. The US Treasury relied on foreign buyers of US bonds over the last number of years to fund the deficits. Certainly the foreign buyer has become less interested. And that's important for two things. One, it's important for the US bond market because there's a lot of funding that's going to have to get done to fund fiscal policy. And second, it's important for the dollar because to buy US Treasuries, we need US dollars. And certainly US dollar has been under less accumulation, certainly maybe into distribution by investors who have taken the safe haven asset and bought riskier assets, hoping to get a better return than ultimately a negative interest rate, which is the rate of interest on US Treasury bonds minus inflation, which is a negative return currently. So just from a breadth perspective, we talked last week about the fact that we have seen, some sloppy breadth over the last few weeks in Canada, in the US, globally. That means the percent of stocks across the broad markets that are in uptrends has been declining somewhat, meaning there have been some weaker stocks falling away. Now, we like markets where breadth is expanding. And we like that because when breadth is expanding, that's what makes a bull market. There's no bear markets in history that ever took place while breadth was expanding. So when breadth is contracting, we want to understand where is the weakness so that we can avoid it. We only want to focus in groups for seeing expanding breadth. Now, last week, we talked about the fact that breadth has been strongest in financials, which would include the regional banks, the large banks, the insurance companies, steel companies, metals producers, oil service, certainly some of the consumer staples, precious metals, retail. And on the other end of the spectrum, there were several groups that have been favorites of a lot of investors over the last many years that have had weak breadth. So as we move down this distribution curve, it means fewer and fewer stocks within these groups are performing constructively. In the semiconductor group last week, only between 16 and 20% of all semiconductor companies were in uptrends, meaning that over 80% of stocks in the group had been weakening on a price basis. And that was the same for internet, biotech, drugs, software, a lot of growth stocks, healthcare, electronics. So what we said was our focus is in these groups that are more economically sensitive, that have stronger breadth, but we recognize that these growthy groups are starting to get sold out from a breadth perspective, and that very possibly you could see some kind of rebound over the next small period of time. So what's happened? Breadth, this is breadth for the NASDAQ. Starting in February, we went from 72% of stocks in uptrends to 46% of stocks in uptrends. But you can see that today the chart point is at 51.4. So it takes a 3-box reversal, or 3-1-2-3 box reversal, to go back into a column of X's, which means, again, breadth is expanding. 52% would do it. This morning we were at 51.4. It's very possible that today, during the day, we got enough new buy signals in the NASDAQ to reverse it back up into X's, which would mean we're back into sort of green territory. And we'll see what can happen from there. But we would say there are some positives from this week. While breadth for the big models did not turn higher, volatility, which has been making lower highs over the last number of months, again made another lower high and is sitting now back down at 17, which is the low end of the range. So volatility broke back down again. That's good because it means that we are not expecting, the markets are not expecting higher volatility. From a sector perspective, what happened over the past week? Well, those groups that we talked about having weak breadth, some of them saw reversals. Biotech, now in capital letters, means back into X's, where breadth is expanding. Internet, breadth expanding. Software, breadth expanding. Healthcare, breadth expanding. Semiconductors, leisure, computers, you can see it. So markets correct one of two ways. They correct in time by going sideways, or in price. Some of the companies in these groups went through a price correction over the last several weeks since the beginning of February, but are now seeing some improvement. The groups that have been leading, the breadth has remained strong. And so what we can say is that the weakness has been concentrated in secular growth stocks that now are trying to find a footing. In a healthy market, more and more stocks, more and more sectors participate. This means that the breadth looks like it's starting to expand again. And the key groups we're focused in have simply been consolidating. So let's talk a little bit about that. XLF, the financials ETF, over the last 3 weeks, basically sideways consolidation and a little bull flag. That's a bullish price formation. It means that it continues to be accumulated, whether it's being made forward progress or not. Most likely you come out to the upside. Materials, again, a very similar flag pattern, which means that the market has just been consolidating this gain that we've been having. And this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. So that's nearly 4 weeks of consolidation, very healthy. No major problems, no major deterioration, time. And that makes sense because demand is moving sharply higher. In the most recent month, carloads of commodities up 26% year over year on a 4-week average. Now let's talk about an important part of the commodities market, because several weeks ago we were asked about gold on this call. And this is the GDX index, which is the index of senior gold miners. And this is a chart from sometime in March, March 16th. And what we saw was that after a long consolidation over a few years, the GDX broke out to the upside into last summer and then consolidated. Now we said this looks like a consolidation. We've traded right back to where we broke out. We would expect to see a reversal soon. Let's look at that same picture today. This is where we were then. This is where we are now. So we've broken out of that little flag pattern, that handle. We call this a cup and handle. Most often when you eventually break out of that consolidation, you would look for an upside target approximately the depth of the cup. And so if the bottom of the cup is at 1100 and the top end of the cup is at 1800, we might expect to see 26 or 2700, which of course from here is a long way. So very bullish for the golds. When we looked at the leaders a couple of weeks ago, we made a comment that Newmont, ahead of the group, had broken out of this little flag as the leader and now trading here at new all-time highs, following through nicely. Again, another bullish sign. We always want to follow the leaders. When we look at the silver stocks, this is the SILJ ETF. That's the Junior Silvers Miners ETF. You can see it's also been in consolidation since August of last year. We broke out. little tiny flag pattern here. This is a very bullish setup. I would expect probably we break out of that over the next short period of time. And the tell would be some of the leaders and companies. This is a very long-term picture. Again, that's the consolidation. This is the much longer-term consolidation going back to 2017. And when we look at the leaders, one would we look at is Endeavour Silver. Not only came out of the consolidation, but it's continued to march smartly higher. So again, the leaders are generally the tell. Newmont on the gold side, Endeavour looks like one of the leaders on the silver side, but in both cases coming out of large consolidations, certainly bullish. On the energy front, we talked about this long-term downtrend line that was in place from 2014. We finally got above it a couple of weeks ago. Again, we've consolidated, much like other parts of the market. Again, most likely to come out of a flag from the direction we came in. So important for the Canadian market. Let's talk industrials. Oh, same price pattern, consolidation over the last 4 weeks. And let's put it all together. Value. This is the RPV S&P Value Index, made up primarily of some of the groups we've been talking about. Again, very similar picture. So while we've been consolidating, breadth in these groups has been hanging on nicely. And when we look at the growth ETF, while we have been consolidating, we're seeing a little bit of strength coming off that moving average. And it may be that the growth stocks are getting ready to reignite. We will see. We choose to focus in what we consider to be the leadership. We've not seen enough evidence to say these growth stocks are going to rejoin the rally, although it's very possible. So we'll watch closely. We'll look at adding positions, but what we see is significant flows into value, and the flows are significant, but they've been flows out of value for many years. So we think this is a very early stage, and we put this chart up last week, showing that the last time that growth outperformed value so significantly and then value took over was sort of toward the end of the tech boom in 1999. So we'll see where things go, but certainly it looks as though value continues to hold the baton. Other evidence of value leadership, this is the EZU ETF, which is European stocks consolidated since 2008, made no progress. Several weeks ago broke out, and it's just continued to march smartly higher. The difference between this and the S&P is much larger weighting in financials and industrials, which of course, have been leadership. So in our macro portfolio, we do have an exposure here. Other global markets that are important, China, certainly we talked about the fact that it broke out of its range back in September. We rallied into the early part of the year. Now in China, coming out of the pandemic early, lots more sort of saber rattling around managing inflation, certainly in commodities, and the market did check back to the breakout point, but made a nice turn. And as often is the case, after checking back to the breakout, has started to accelerate, and we got really big flows into Chinese stocks this week. In fact, the best flows into Chinese stocks since late 2019. So we'll see whether that continues, but that probably makes this a pretty good entry point. On Taiwan really hasn't looked back since it broke out in May of last year. We had a little bit of weakness over the last 2 months, but again, smartly higher over the last 2 weeks. And after consolidating, it looks as though Korea also ready to reignite to the upside. And so we put that together, PIE, which is an ETF of emerging markets companies. Again, after having broken out of that big range, consolidated over the last many weeks, looks like it is reaccelerating as well. All of these things are things that do well when the economy is improving. Now, what is important is that while the emerging markets ETF was consolidating, institutions yanked their money, and the exposure of hedge funds to emerging markets dropped considerably. So at this point, certainly it's not a crowded trade, it's not overowned, and on reacceleration could bring a lot of new dollars to bear in these groups. So we like to be in groups before they're crowded, and certainly we have some exposure here in our global portfolio. When we take all of the global markets from a breadth perspective, we've recently seen good strength in Hong Kong, China, Thailand, Malaysia. So that's the Asia Pacific, and some good strength in India. We'll see whether the US market breadth model can get turned back higher. Looks as though NASDAQ turned back up today. And then, of course, the dividend growth theme is alive and well. And this is where we're focused on the income front. Actually, dividend growth ETF, or DVY, is outperforming the S&P. And that should happen in a world where interest rates are rising. You want a rising stream of dividends. So last couple of things. I hear a lot about the idea sell in May and go away. And there certainly have been lots of years where the summer months are difficult. But I want to take this data and look at it in another way. So this is all the years from 1981 through the present. Obviously, the ones in green for the Dow were positive and the ones that were red were negative. Now, all markets are not created equal. And I spend a lot of time talking about understanding the type of environment that you're in and positioning for it. When we look at structural bull and bear markets, structural bull markets are better for stock investors. We know that we had a structural bull market from 1991 through 2000, and then a much choppier market from 2000 to 2013, and a much more consistent market from 2013 to present. Let's look at those date ranges. 1982 through 2000, 1, 2, 3, 4 negative years. 4 negative years out of 18. Well, that would say in that structural bull market, summer was pretty good to Dow industrial stocks. Then you've got 2001 through 2013, 1, 2, 3, 4, 5, 6, 7, 8, 9 negative years. Well, it was a structural bear market. Now let's look at 2013 to present, 14, 15, 16, 17, 18, 19, 20, 1 negative summer. So we think that there is pretty good leadership in the market currently. We'd like to see breadth across the board continue to improve, but based on our work and based on the structural themes, we have 3 basic jobs. Number 1 job is to identify market leadership without a bias, wherever it is, and focus in those areas. We don't have to be everywhere. Watch closely for change. And we saw lots of change last summer into fall as value sectors started to take over and reflation in the market began. Reflation could go on for a long time. We were in a disinflationary world from 1981 through 2020, 39 years. So it's very possible we could have several years in front of us and these reflationary themes continue to be under-owned. In the event that there is nothing working, be prepared to play defense. So we are pretty fully invested currently. We do have some clear leadership in the market. We watch it every day. We run stops under every position. But we prefer not to take market generalization like sell in May and go away, or be in every group approximately the weight of the index. We prefer to be targeted. We prefer to be tactical. So as we sit today, we do have a very focused portfolio across the firm. And of course, every mandate's different. Financials continue to be a very significant weight. And the reason for that is from a risk reward standpoint, these are great companies that have been held back from growing their dividends and buying back shares for several years. Their balance sheets are in good shape, and they win when the long-term interest rate starts to rise, and the differential between a short-term rate and a long-term rate gives them an ability to make money. So we're invested in banks, insurance companies, asset managers, capital markets, banks, and we expect great dividend growth and good risk reward in those areas. Energy is a reasonably substantial weight at just over 12%, materials at just over 12%. These are significantly larger than the index weight. Industrial is a little bit overweight. And you can see on the other end of the spectrum, healthcare, telecom, utilities, consumer discretionary, consumer staples, real estate, and tech. All of them groups that would be more useful in a disinflationary environment, very small weights in portfolios. So we watch for change. We use our stops. We look for new leadership to emerge. But at this point, it seems to be sort of steady as she goes. We're very prepared to play defense when the time comes, in these periods where markets have been rocky. We've been very quick to get defended, and that's something that we continue to intend to do. But in the near term of the changes that we're making, we have increased our weight in precious metals over the last few weeks. We certainly have been increasing our weight slowly in financials, and we'll continue to watch for change. So thanks so much. Sorry we didn't have a live call this week, so we won't have any questions. But if you do have questions, don't hesitate to reach out either to me directly at dburrows@barometercapital.ca. Hit us up on Twitter at barometerca, where we do post things regularly. Don't hesitate to subscribe to our webcasts. And if we can help you in any way, we would love to hear from you. Don't hesitate to give us a call. Everybody have a great week, and we'll look forward to seeing you again live next week. Have a great day.